Modern trading platforms are flooded with macroeconomic news feeds, earnings alerts, and a web of lagging mathematical indicators. It is incredibly easy to suffer from analysis paralysis when trying to process geopolitical developments and complex oscillator formulas simultaneously. Dow theory offers a sharper lens. It posits that price discounts everything. Every macroeconomic data release and institutional order is ultimately reflected directly in the open, high, low, and close of a price bar. This minimalist line graph charts an uptrend with a stair-step sequence of higher highs and higher lows. When supply overtakes demand, the graph shifts downward into a downtrend, creating lower highs and lower lows. Eventually, the market hits equilibrium, flattening into consolidation between horizontal boundaries. Identifying these states in hindsight is simple. The true challenge, and the primary objective of price action trading, is identifying the exact moment the market transitions between them. Structural shifts dictate the overarching roadmap of the market. A break of structure occurs when a prevailing trend continues by taking out a prior high or low, while a change of character serves as the earliest signal of a potential reversal. In this uptrend, the change of character happens when the price closes below the most recent higher low. Buyers have lost the conviction to bid prices higher, allowing aggressive supply to break the structural floor. Zooming out, that change of character takes on broader context. The initial advance formed the left shoulder, the deeper push created the head, and the subsequent failure to reach the previous peak created an exhausted right shoulder. To calculate the profit target for this breakdown, you measure the vertical distance from the peak of the head to the neckline. Projecting that distance downward from the breakout point identifies where the selling pressure is likely to reach equilibrium. Double tops show a similar failure. When price pulls back from a peak and then fails to exceed it on a second attempt, it confirms a supply ceiling where sellers are actively overmatching every attempt to break higher. In a bull flag, a sharp vertical advance, or flagpole, is driven by institutional momentum. The market then takes an orderly breath, consolidating in a tight downward sloping channel before it breaks out and resumes the upward trend. These geometric structures provide a visual map of institutional momentum and trend exhaustion. However, they are often too large to provide a precise, low-risk execution trigger. Finding a safe entry point requires zooming in from the macro roadmap to the immediate order flow of individual candlesticks. This pin bar features a lower shadow comprising 2/3 of the total candle length. This long wick proves that institutional liquidity stepped in to absorb all sell orders and drive the price back into the upper range. The engulfing pattern shows a more immediate power shift. A small bearish candle is completely eclipsed by a subsequent large bullish candle, demonstrating immediate demand dominance. The inside bar signals volatility compression. The entire range of the second candle is contained within the first, creating a coiled spring that precedes a directional expansion. Support and resistance function as broad liquidity zones teeming with retail stop orders. Bull traps occur when institutions intentionally spike the price above a resistance zone to trigger retail buy stops. They use that sudden pool of liquidity to fill massive sell orders, slamming the price back down into the range. The break and retest strategy uses a 4-step confluence framework to filter out these liquidity traps. You ignore the initial breakout and wait for price to retrace to the broken resistance level on lighter volume. You only open a position upon the close of a bullish confirmation candle directly on that retest level. Combining a macro roadmap with a micro candlestick trigger at a key liquidity zone creates a highly asymmetrical trading edge. Technical analysis serves as a framework for identifying setups with positive mathematical expectancy. The 1% rule keeps risk constant. By dynamically calculating your position size based on the distance to your stop loss, you ensure that no single trade risks more than 1% of your total account equity. This risk is then measured against a target reward of at least 2 units. Setting a minimum 2-to-1 risk-to-reward ratio ensures your winning trades always outpace your losing ones. This math is statistically powerful. At a 2-to-1 ratio, a trader only needs a 34% win rate to achieve long-term profitability. Loss aversion often tempts traders to widen or delete stop losses during an active trade. This emotional impulse is the primary cause of catastrophic drawdowns. Managing trades mechanically helps eliminate this bias. By moving the stop loss to break even once the first target is hit and trailing it behind structural swing points, You lock in gains while allowing the trade to reach its full potential. Price action trading rewards the discipline of managing mathematical risk and regulated emotional impulses, all through the lens of a clean chart.